Hussbus bus stop.
Hello, everybody. This is Nick Hussey here with the Hussey Team Mortgage Advisors, coming at you with this week's Hussbus bus stop. Hope everyone is well. I'm excited to be doing this video. Today, I wanted to talk about the 5 most common myths and misconceptions I hear when buying a home and obtaining a mortgage, okay? So let's jump in it with our number 1 misconception. You need 20% down to buy a home. You can't buy a home without 20% down. False! Okay? False! Sorry, I'm getting a little heated because I hear this one all the time. It's not true. And I think why a lot of people think you need 20% down is because on the most common loan program, conventional loan, okay, if you don't put 20% down, you'll be subject to what's called mortgage insurance, right? Mortgage insurance is not as bad as it seems, okay? It can be as low as $20 a month, depending on the loan amount and your credit score, and you'll be saving thousands of dollars up front, okay? So it's not as bad as it seems, mortgage insurance. Let me tell you how low you can go. So on this conventional loan programs, you can go as low as 3% down. On FHA, you can go 3.5% down. And then on some programs like USDA, and if you're a veteran, VA loans, you can go as low as 0% down, okay? You honestly might even get better interest rate pricings by putting less down. The reason for that is because, like I said, the mortgage insurance, you put less than 20% down. That takes some of the risk off the lender because now there's insurance that's backing them. Now that there's less risk, the lender is able to also offer a lower interest rate. So even by putting less money down, you might get a better interest rate in turn for it. Something else I want to explain, the difference between down payment and closing costs, all right? So down payment and closing costs are 2 different things. Down payment is just what you're putting down on the purchase price of the loan to get your loan amount. There's also closing costs after that. Appraisal, credit report, title fees, recording fees, escrow fees, taxes, and insurance. So just keep in mind, even if you're looking at these 0% down options, which are out there, you're still probably going to have some charge in closing costs. So keep that in mind, okay? Let's move on to our second misconception. You need to be debt-free to buy a home. False. You can still have and hold some debt and get a home as well. Think about it. Everybody in America has some sort of debt for the most part, you would think. And they're buying houses out there, so you can do it. When we're looking at debt, the main thing we look at is what's called a debt-to-income ratio, or DTI, okay? All this is it takes your total monthly debts that are on your credit report, so the total monthly payments you're paying every month, plus the new estimated monthly mortgage payment. Then we divide that by your total monthly income, and it gives us a ratio, which is this debt-to-income ratio. If that ratio for conventional loans is below 50%, you're usually going to qualify. And for FHA, VA loans, it can be up to, I've seen even 58% or even higher on VA loans. So you can definitely still hold debt and get a mortgage, okay? To go on a more specific debt, a lot of people are worried about their student loans and not qualifying. They have made it easier this past year to qualify with student loans. They will only hit you if they're in deferment, okay, meaning you're not making payments right now. They'll only hit you for 0.5% of the total balance of the loan, which is honestly not that much. So they've made it easier. Don't be scared if you have student loans to get a house, and don't be scared if you have some debt. You can still qualify a mortgage and buy a house, okay? Moving on to our third misconception about obtaining a mortgage and when buying a home. Third one is, you need to find the right house first before you talk to a mortgage advisor. False. Not true, and I don't advise against that. I advise against that. Sorry. So you can find a house and then talk to a mortgage guy. Go ahead and do that. But who knows if you're even going to qualify for it? Who knows if it's even going to be within your budget? These are things you want to plan ahead. So I always recommend, if you're a year out, 6 months out, I would get in touch with a trusted mortgage advisor right now to structure a game plan so you know what you qualify for, so you know what types of houses to looking at, and so you can start realistically thinking about your budget So you can start game planning how much money you need to put down. What do you want your payment to be? What purchase price is going to give me that payment? Do I even qualify right now? Do I have enough income to show? Am I showing too much debt, like our previous example? What's my DTI? What's any of this mean? You need to talk to someone first before you find the house, or you could get in trouble, okay? So definitely not true to find the house first before you talk to a mortgage professional. Talk to someone first, then start looking for the home. Our fourth misconception here. The lower the interest rates, always the better option. False. Not true. Now, I will agree, lower interest rates better than a higher interest rate if we're just looking at interest rate. But what you're missing is maybe there's something to attach that interest rate. And the most common thing you see attached to the interest rate is what's called points, okay? Online, you might see a lot of lenders showing really low interest rates. And to be honest, some of them could be true interest rates. But what you'll see attached to a lot of these low interest rates are what's called points. Now, points are just a fee you're paying at closing for this interest rate. It could be $100. It could be $10,000. You have no idea until you check. So you could be seeing a rate of 2.875, but maybe they're charging you $15,000 for that rate, okay? So lower interest rate is better, but it's about what's attached to it, okay? You also want to see, are there lender fees attached to it? Is there a lock-in rate attached to it, okay? The other thing that separates with mortgage rates, you might see a lower mortgage rates on shorter term mortgages. So 15-year, 10-year, 20-year mortgages most likely are going to have a lower interest rate than a 30-year mortgage. Then, hey, Nick, I should just go with one of those lower terms mortgage. It might not make sense for you because think about it. 10-year, 15 years, 20-year mortgages, the payment's usually going to be higher than that 30-year mortgage, even with the lower interest rate because it's scrunched down a lot smaller, okay? That's why you see most people looking at 30-year mortgages because it makes the payment more affordable. Now, yes, the interest rate might be higher, but the monthly payment's going to be lower and it's going to fit your budget. It's going to make more sense for you. Okay, and our final myth and misconception when buying a home or obtaining a mortgage is all lenders are the same. Not true, false, okay? You'll see if you're working with a bigger bank, a lot of them work 9 to 5. Completely fine, normal business hours. But in this crazy market, you need someone that you can reach on the weekend, someone you can reach late at night, someone you can text. A lot of these people don't text. Houses are going on the market in a day and they're selling that same day. So you need someone to work quick with you. And a lot of it's happening over the weekends. You need someone there at all times to be able to work with you and get you information quick and efficient. We do that well here. So definitely our lenders aren't on the same in terms of how you reach them and how quick they're going to be. The other part where not all lenders are the same is there's some lenders who are just going to give you a pre-approval, tell you, hey, what do you want? And they'll just do it for you. Where we come in, where I think we're better, is that we're going to help advise you. You might not know a lot about loans or the programs you're getting into. We have so much knowledge. We're going to advise which way you go. We're not going to force you to go away, but we're going to give you a bunch of different options. And we're going to look at something I keep talking about, your budget. Budget is so important, okay? And that's something we really dive into deep here. You might qualify for something, but if it's outside your budget, you can't live a normal lifestyle. You don't want to be chained to this mortgage payment. You can't go out and do anything or live a normal life because the mortgage payment's too high. We're going to look at your budget and really help you narrow down. These are the type of price houses you should be looking on to stay inside this budget, okay? And that's pretty much it. I appreciate you all sticking it out here till the end and going through these 5 misconceptions with me. Any questions at all, you can always reach out and hit us up. But thanks again. Have a great week. Wish you all the best. Love y'all. So long. I'm out.
Hussbus, bus stop.